Welcome to Charts Today. My name is David Linton, and this is the last edition for 2016. We'll be back in the new year, and this edition for Friday, the 23rd of December, comes to you from the Dead Sea in Jordan. We start by looking at the currencies, then we'll look at stock markets, some commodities, and just really a little bit more of an outlook for what we think will happen next year. So basically the dollar strength, we've talked about this now for months, and we do see that 2017 is going to be a strong year for the dollar. And to put that into context, this is the move that we had in 2014, a 25% appreciation in the US dollar. We wouldn't be surprised, having seen this breakout now, to have the same level of appreciation in the year ahead. This is a massive breakout after 2 years of sideways movement, and the general rule in technical analysis is the move into the pattern is what you expect when you get the move out, so the same again. So we see very significant upside for the US dollar next year, not showing up so clearly on the medium-term targets at the moment. We do have this short-term target, but the long-term target on the 1% point and figure chart is stellar. There's only one of them at the moment, so multiple targets normally gives more credence to a move, but at the moment strong dollar is the theme. And we also believe then that 2017 is the year that the euro will completely collapse. And at the moment we're making new multi-year lows. Really haven't seen these levels since way back in sort of the 2003 time. If we go right back in the chart, we see here we've not seen these levels until over 13 years ago. And again, move into the pattern, sideways move out. This is very much in keeping with what we expect in technical analysis in terms of what will happen in the coming year. We've now broken down out of that pattern, expect to make new lows. And of course the point and figure targets, the really big news was this week we actually activated this downside target of 60 cents to the dollar. So that is really scary. We've had 75 cents hanging over us. So that means €1 will cost 75 cents. If we go all the way to 60, €1 will cost 60 cents. Now we may not get to this extreme target, but the fact that we had this target that was 108 given way back in 2008, now given, this may take years to unwind, but we will start to see collapses much like we've seen in sterling this year, and we've got downside targets to below parity. We've got quite a lot of downside targets near parity. We've now got new downside targets on the medium-term chart to below parity. 92 is the latest target. So it almost looks certain that sometime in the new year we will go below parity, and of course there'll be lots of news headlines feeding that, and we'll expect to see lots of bad news out of Europe as a result. Don't be surprised to see the euro collapsing next year. The yen rate, again, it's all about dollar strength. We've been as high as 118. Weak yen, strong dollar. And sterling had a very bad year in 2016, of course, but it's not over yet. We're trading today at 122.50. That's back near the lows that we saw in October, and we've hit real resistance on the cloud here on the daily chart. We've got lots of downside targets. If we look at the long-term downside targets, parity here 102. In the backdrop of that strong dollar, we will see sterling going lower still. We've got 120 as the short-term target, 117.90. It's almost quite likely in the new year that we will be below 120 to the dollar. So that is really the picture. How do you resolve how that looks against dollar euro? Well, sterling has had a little bit of recovery, but is now falling away again. 117 is the target at the moment. But we're seeing bigger downside targets for the euro against the dollar than we are for sterling, if you like. Sterling's had most of its moves, and the euro now has more of its own big moves to do. So although we're bearish in the short term, we are seeing a recovery in the medium term against the euro for sterling. It's all relative. Looking at the Swiss franc, of course, a safe haven currency. We're seeing that turning away, and it looks like Switzerland will become more expensive next year for British tourists, skiing especially. Australian dollar is quite an interesting one to look at as well. We see here that we have got back to the 170s. We were into the 150s very briefly, just below 160. Back in October, but the reality is this recovery is looking a little bit short-lived. There is some support, and there are quite a lot of upside targets. So weaker Aussie dollar is a factor as well. Now, taking a look at stock markets, we didn't quite get to the new highs that we have heard all about in the recent days, but the reality is that the stock markets are looking pretty bullish. Thin trading at the moment as we go into the Christmas period, of course, and will be over the new year. Markets traditionally rise quite strongly over the Christmas period and early new year, but last year we didn't see that happen, and that may be the case again this year. We just need to watch out for any pullbacks. But whilst we're above the 60-minute cloud, we can take some relief that we are holding on to the gains, and so again, markets making new highs is good, and we're seeing that in terms of all-time highs for many of these indices. The Nasdaq did hold the 49,000 level, the psychologically important 5,000 level. We may not just get through that for the year end, but it's looking pretty bullish and quite a lot of short-term upside targets. So everyone's fearful that we're not going to make these highs by the year end. It's slightly academic now. It looks like we will, if not before the year end, certainly sometime in the new year. And the Russell 2000 again has been very strong since the Trump election. Just look at the way it's just run, and we're seeing that breakout here, breaking the 2015 high and holding those gains. So that's also significant. The big story, of course, is will we see the 20,000 Dow? I remember way back in the 80s, the headline on the FT was "How now 2,000 Dow?" Now we're looking at 20,000 for the Dow Jones, so tenfold increase over the last 30, 40 years. We've obviously had 10 pretty tough years for stock markets, but the Dow is really just continuing to motor. And the question is not will the Dow Jones break through 20,000, it's when will it break through 20,000. And a lot of people thinking that might happen before the year end. If not by the year end, certainly in the new year. It's looking likely pretty damn soon. If we look at the FTSE 100, good to be back above the 7,000 level before the year end. Again, FTSE traditionally does quite well between Christmas and New Year, so we expect to hold the 7,000. More importantly, we take out the 2015 high, just above, say, 7,120, then that would be very positive for FTSE as well. So we're expecting a better year for the UK stock market. And if we look at the FTSE 250, again, the picture is pretty bright here. Mid-cap stocks running at the moment, breaking higher in the last few days. We've got 1% upside, 9.5%, 7% upside targets here, 6%, lots of targets to 6% upside. So it is suggesting that mid-caps will have a better year in the UK next year. Taking a look at the DAX, DAX has actually just flattened a little bit here, but the breakout that we saw in the last few weeks has been highly significant, taking us into bullish territory. Weaker euro generally means, of course, stronger profits for European companies, and that's filtering through to German companies. Weaker euro means bigger exports, more profits for European investors. But of course, if your dollars are nominated, that may be wiped out by any falls in the euro. The Japanese Nikkei market has been really amazing as well. Nikkei breaking through the cloud for the new year. The Japanese will be watching these Ichimoku clouds quite strongly, and again we've got upside. Not a lot of clear upside targets for the market. There is a 5% short-term upside target, so it's just a little bit harder to call there. If we take a look at the Chinese market, this is the one worrying thing for 2017, is what will happen to the Chinese stock market. We are finding support in the short term at the moment as we teeter along the bottom here, and we are sort of just on the cloud support on the price, but the long-term picture is still pretty bearish, and if we did see new lows in the Chinese stock market, that would herald quite big falls potentially. So this is the one worrying area at the moment in international stock markets, is China just doesn't look very good. And if we go through the Hang Seng, we're seeing much the same picture. Hang Seng falling away here, and that is just pretty worrying. Bearish, bearish, bearish on all three time frames. Downside of the short term of 2%, and we do have this long-term downside target of 23%. So the Hong Kong market just looking a little bit worrying as we head into the new year. India has always had quite good long-term prospects, although the last few years we've been really teetering along here. We've got a massive 70-60% upside targets here, a very different picture from what we see in China. But India needs to make new highs in 2017 to actually activate these targets and push us much higher. So we've had quite a lot of turmoil just of late with monetary policy in India, but we do see that if we break to new highs, the Indian market has got some very big upside targets to live up to. So that could be a market to watch in 2017. And the Australian market, last of all, we take a look at moving into positive territory on the weekly chart. So now bullish on all three time frames. Upside potential here of about 17% on the medium term chart. Quite a lot of short term upside targets between 4 and 6%, 5% upside. A lot to play for in the new year for the Aussie market. Taking a look at commodities, the big story this year was that Brent didn't really collapse in the second half. Normally we see a collapse in the price. We've seen that in the last 2 years. Big falls at the end of the year. Didn't happen this year. We've wandered into positive territory on the long-term chart above the cloud. The short-term targets, short-term cloud is a bit bearish at the moment, but the medium and long-term trends are bullish, and we are seeing now significant upside targets: 58, 72, 61, and in the medium term we're seeing 76, 61 again. So lots of targets out of the 50s. It does look like, and we're heading into the strong quarter, certainly the strong half for crude. So it does look like crude oil will have a strong start to the year, and we do see Brent into the 60s pretty easily, maybe even to the 70s by the mid-year. So Brent crude rising basically, and the same picture for WTI is pretty much the course as well, of course. US nat gas, another interesting commodity in the year, breaking through the long-term picture. So really almost waving goodbye to this $3 mark now. Sub $3 looks unlikely. We're now into a new uptrend, bullish on all three time frames at the moment. We've got massive targets here: $5, $7, $4.5, $6. Targets anywhere as high as sort of 100% upside, price doubling basically. So it's looking like a very strong year ahead for US nat gas. We saw in November this complete re-rating from 250 up to 375. That sort of move in the year ahead is looking highly likely. So that's pretty bullish. Most softs didn't have a great year, and a lot of the soft commodity charts are looking pretty bearish on the long-term time frame. Coffee is down 4% at the moment. Did just get through on the long-term chart, but we've got some very big downside targets here, and this needs to be activated. We're right on support at the moment, but a lot of soft commodities just not looking great for the year ahead. So that is just another factor, is that soft commodities, things like oil, looking very bullish, but the soft commodities like wheat here, we are seeing quite a lot of downside potential and a lot of downside targets here on the long-term chart. So just generally soft commodities not looking great. If we take a look at gold, gold has had a terrible second half to the year, got a very strong start to the year. It rose really from 1100 back to 1350, has given up most of those gains, and we're falling back to just find support on the lagging line in the cloud, but the medium term and the short term pictures are pretty bearish, still with downside targets. Will we get the New Year rally in gold? This is the big question we've had it the last couple of years. Will we get the New Year rally in gold? We'll have to wait and see, but at the moment gold does look pretty bearish. If we can find support here, get some buying targets, we might see a reversal, but gold has had a pretty bad end to the year. And of course, much the same is true as silver. Precious metals generally have had a pretty torrid time as we've come to the end of the year here. We do have some upside targets here, but nothing spectacular. No real reversal showing through. Again, will we find support on this chart? We'll have to wait and see. Copper was one commodity in metals that did actually have a good second half in the year. We see this big jump here, really since the Trump election. We just ran in the copper price. We are just selling off a bit now. We see some bearishness creeping in. If we can move to new highs, then we will activate higher prices, but copper is just coming back now. Just looking at bond yields, and first of all we could look at actually the German bond market itself. The Bund still in this long-term uptrend. Medium-term bond prices have been falling and sideways, but really the strong bond market has been the US bond market. If we take a look at 10-year Treasury yields, they've really now held steady at about this 2.5%. We see here we've gone from 1.5% to 2.5%. We've taken really an amazing move here where we've come through the cloud and we're now in bullish territory. That means interest rates. It may not strike you that bond yields are that important to you, but the interest rates in the US now, we've got bond yields targets of 4.4%. 4% upside here. We do have some short-term moves back to 245, 250. All small moves to the downside, big moves to the upside. So we do see bond yields strengthening even further, and of course that's consistent with a stronger dollar and everything that goes with that in 2017. Taking a last minute look at just some tech stocks, we look at we'll start by looking at Apple, one of the bellwethers, of course. Had a pretty bad year actually. 2016 was not Apple's year, but just starting to get back through the cloud. Signs are that we might see a recovery in Apple. We're starting to see upside targets. If we look on this medium-term chart, 23% on upside. Apple making new highs in 2017 looks quite possible. So that is also really significant. Taking a look at some other stocks, Facebook struggled in the second half of the year, did have a really strong first half of the year. The long-term trend is still looking good, but at the moment, if we break below this 115 level, then that would be a bit worrying for Facebook shares. So the key thing, we've got amazing upside targets here, but we do have some new downside targets just creeping in. So technically, not looking as good as it has done. So just an interesting one to keep an eye on. We have this real range now. Below 115 is bearish, above 122 is bullish. That's the great thing about technical analysis. You just look at the levels, and if we break higher, that's good. If we break lower, that's bad. Anyway, that's the roundup for this year. Wishing you a Merry Christmas wherever you may be on the world, and a prosperous 2017. We look forward to seeing you when we're back. Until then, happy charting. Enjoy your Christmas. Bye for now.